A very good morning to all. In this knowledge session, we have a subject of factors to be considered before investing in shares. And we have a very well known faculty, C. Abhishek Zavre, sir. Uh, I think he does not need any introduction. Just one thing, sir. I think I am amongst the first few batches when you started teaching, and I'm
Yes.
amongst the few batches where you taught mercantile law.
Yes. CPT. Initially, we
Yes,
started mercantile law and then shifted to the accounts.
yes.
I think in your batch, I got married also. It was
Yes,
your batch, I think.
your batch. Yes, my batch only, sir. So
You
in
people
that
had
batch,
troubled me a lot.
mercantile law, you covered the mercantile law in only three characters: Abhishek Bachchan, Aishwarya Rai, and Salman Khan. Yes. So
Yes.
without wasting time, I would request Abhishek sir to kindly begin with the session.
Thank you, Chaitanya. Thank you, Pune Camp CPE Study Circle, for inviting me for this wonderful session. In today's session, I'm going to talk about factors that we should look at while investing in stocks. See, without wasting too much of time, let's head straight into the topic. This is a wonderful quote by Mr. Warren Buffett, and I find this particular quote aptly perfect in this particular time. People say that the economy is in trouble, economy is in lockdown, world over we have entire economic activity coming to standstill. What Mr. Warren Buffett said, this was at a time when the economy were in full function. This was not at a time when lockdown was there. Look at his quote. What he says when you buy a stock. Now, Warren Buffett doesn't need any introduction. I never attempt to make a money on a stock market. I buy the stocks on the assumption that they could close the market the very next day and don't reopen it for the next 5 years. And we are talking about economy being halted for about 2 months, 3 months, or maybe 4, 5 months. I do understand that the pain that will be suffered by the public at the bottom of the pyramid will be much, much larger, much bigger. But sooner or the later, this pain will get healed by the fiscal packages that are announced by the government. Though government has not been too good so far, right now Nirmala Sitharaman madam is making a final presentation. But over the period of time, government is going to make a changes. Government, RBI, everything is adaptive. We need to understand that nobody has a precedence for an event like COVID-19 or coronavirus. So in this situation, we should not look at just 4, 5 months or 1 year or 2 year down the line. What Warren Buffett says is, if the markets are closed for next 5 years, and I will still buy a stock. So my entire focus of the discussion is going to be on a long term. So I want to begin up with this wonderful comparison between the various economies. Modi government, prior to this COVID-19, had made a dream of achieving $5 trillion nominal GDP for India. This is nominal GDP. This is not a real GDP. So Indian economy is approximately at a $2.7 trillion in terms of nominal GDP. 1 trillion is approximately 1,000 billion, and 1 billion is approximately 750 crores, 7,500 crores. So $2 trillion economy to the $5 trillion economy. If I look at the other countries, China took just 5 years. From 2004 to 2009, USA took about 11 years because USA already per capita income were quite high. So the opportunity or the, let's say, enthusiasm of the public at large to work harder gets diminished when your per capita income rises substantially. So USA took 11 years, Japan took 8.5 years. India has already hit the $2 trillion mark somewhere in 2015. How long will it take for India to achieve this $5 trillion mark? That is doubling of the economic size. We are already at 2.5 trillion approximately, and I believe that next 7 to 8 years, India will achieve that particular mark. Whatever Modi government had promised of 2023 to 2024 seems little tough now. But 8 years down the line, we will be doubling the size of economy. That means the nominal GDP that India has as a country has achieved in the last 70 years can be achieved in the next 7-8 years. And this is really not dependent on the what government we have at the center, what government we have at the states. This is basically spirit of Indian public. So with that introductory comment, let me explain what factors we should look at while making investment. I have divided my entire discussion into 4 broad areas. So you will get a better idea of what we are going to discuss in next 40-45 minutes, and then I will have questions and answers at the end. Whatever question answers you have at the end, I will go through the chat. Right now I can't see the chat. So first, some basic factors which normally every person who has gone through the chartered accountancy course or MBA finance course would be aware about, but it's good to have a quick recap of those basic factors. Then there are some fundamental factors to discuss upon, and then wonderful technique I'm going to discuss with you. Because see, everyone knows what factors I should look at. Everyone knows what the PE ratio is, or how the PE ratio is calculated, or how the return on equity is calculated. ये सब बड़ा बड़ा ज्ञान हो गया, ये सबको पता है. But ultimately when it comes down to decision making, boss, is there any basic technique? Are there any basic predefined rules? Because normally a lot of persons understand the knowledge, but when it comes down to application of knowledge, they face a problems. So there is one technique that I am covering, Canslim technique. This is a technique given by a legendary investor, William O'Neill. He's 87-year-old investor. So I'm going to cover up one technique that is basically going to cover the fundamental factors and some technical factors also. And finally, my last part will be investing in uncertain times like this COVID-19, what you should look at. So let's begin with the basic factors first. So within the basic factors, when you try to look at, one must look at first and foremost the profitability of the company. So in terms of profitability, I'm going to look at certain basic ratios. What money company is earning for equity investors, the return that it earns for equity investors. After paying all taxes, what profit remains divided by net worth that is provided by equity holders. That is return on equity. Then I should also look at return on capital employed. Return on capital employed is on overall capital, equity capital plus debt capital. So what operating profit company has earned with reference to the total capital that company has got. Now, typically a ROE of 17 to 20% and above is good ROE in Indian markets. I will say, sir, why you said 17 to 20%? See, the interest rates typically that are offered by the bank fixed deposits maybe or a long-term debt funds could be in the range of 7 to 9% right now. So 7 to 9% is what debt is offering me. So for equity, I need some risk premium. If I'm making an investment in equity, I'm looking at the company which can compound the capital that is provided to the company at a faster rate than the rate at which you have interest on debt. Nominal, let's say, if I talk about a real GDP growth of India, real GDP of India is expected to grow at, let's say, 6-7%, not this particular year, in a longer term. Plus, I add 4-5% of inflation. So your nominal GDP is growing at 9, 10, 11%. That's what Ms. Nirmala Sitharaman had said in the budget of 2020, and where she got confused in terms of GDP growth rate. So if my nominal GDP is growing at 10, 12%, at country is growing at that rate, I want to invest in the company which is growing their capital of investors at least 1.5 to 2 times of GDP growth rate. So that is return on equity and return on capital employed you should look at. Don't invest in the companies which are not rewarding their shareholders appropriately. Then the next is operating profit margin. Your EBIT, earnings before interest, tax, depreciation and amortization, EBITDA. Operating profit as a percentage of sales I should look at, because ultimately if I'm earning profit by way of other income or by some accounting adjustments, that is not good. I want to invest in such a company which has good solid operating fundamentals. So out of the sales of 100 rupees, how much is contributed towards operating profit? That is what I'm going to look at. Net profit margin, net profit as a percentage of sales should be again good enough. Now, operating profit margin, you should look at the industry to industry. It will vary. There are some industries which are operating at 5-6% operating margin. There are some industries which are operating at 25-30% operating profit margin levels. Because if operating profit margin is lower, it is backed up by a volume. And for that, we have wonderful analysis that you can do for any particular company called the DuPont analysis. DuPont analysis basically says that return on equity or return on capital employed is basically a multiplication of two things: your operating profit margin and your asset turnover ratio or capital turnover ratio. So in simple language, let's take a simple example. My return on capital employed is operating profit divided by total capital employed. I split this into two parts: operating profit divided by sales multiplied by sales upon capital employed. If I do that, I simply get the two key factors for any company to earn a return for their shareholders. And those two key factors are volume and margin. Volume game and margin game. These are the two key critical factors. So I must try to understand how margins are there. If margins are lower, is the volume substantial? Volume growth is there or not? So either you play a volume game or you margin game. Very rarely you find a companies where there is a great volume and there is a great margin also. So look at that margins, profit margins, operating profit margin, net profit margin. Look at the growth rate of sales in terms of volume, in terms of sales amount, because prices can change. So you calculate a compounded annual growth rate of sales, operating profit, PAT. Now these are the factors. How do we use these factors is I'm going to cover in next session, that is Canslim method, next part. Then of late, many people have started looking at cash flows rather than looking at accounting profit. Unfortunately, accounting profit is getting affected by accounting policies or management's estimates. So what people have started looking is, are you generating cash? And these uncertain times, cash is the king. You know, during this COVID-19, cash is the king. So how much cash business has generated? Now, typically profit after tax plus depreciation is called the cash generated, but that is not what you should look at. PAT plus depreciation or other non-cash adjustments, if I do the add back and I do adjustments for capital expenditure that company is supposed to incur, loan repayments that it has to make in the subsequent future or near future, if I adjust for that, what we get is called the free cash flow. So free cash flow is simply your PAT plus depreciation or other non-cash adjustment plus or minus working capital changes that happen in a business minus capital expenditure that is required to be incurred for achieving business objectives minus debt obligations. If I do that, I get free cash flow generated by a business for equity holders. So are you generating a free cash flow? Look at the free cash flow growth, because sometimes you may come to know that companies are earning good amount of profit, but the cash flow generation is not taking place. So ultimately, I want a cash, because cash will indicate the ability of the business to grow faster in the future. And the last one in terms of profitability that one should look at is economic value added. Economic value added basically says whatever profit you earn, that profit should be compared with cost of capital that you have got. Typically, company gets a capital from debt and equity, but obviously this capital doesn't come free. There are expectations of investors. Those expectations is known as a cost of capital. So if I take a profit after tax and I deduct cost of capital, what we get is economic value added. This is a concept which was coined by Stern Management Company in the New York, and they have pioneered this particular concept. Many Indian companies, especially IT sector and FMCG sector, do report economic value added in their annual reports. So I should look at these profitability factors. Now, you will say, sir, from where can we get these factors? Typically, you can pull out the data from financial statements and do these workings, or there are some websites like screener.in or TickerTap is another website. Screener.in, TickerTap, or maybe Yahoo Finance. These are the websites where you can get this data very easily, or Stock Edge करके एक app है. You can find out the data on multiple websites, but you should always try to rely on the bare data that is coming up from annual report of the financial statements for profitability calculations. So basically, invest in the companies which have provide or which have earned good amount of profits, about 20% ROE, what I personally look at while investing. Then look at the operating level efficiency of the company. Within how much, what is the average time during which debtors make a payment, average time that you take to make a payment to the creditors, average time to churn the inventory, working capital cycle, number of days to convert the raw material into finished goods and finished goods to be sold and then money being recovered from customers. What is your operating cycle? Because if this working capital cycle or operating cycle is increasing, is getting stretched, it means there is a short-term pain through which a business is going. Recently, one company called the Manpasan Beverages went through a kind of a turmoil, and I don't know where that stock is headed. It could be in hardly 1 or 2 rupees, maybe. This Manpasan Beverages, their operating working capital cycle or operating cycle was getting increased because of some wrong doings that were done by the management. So you, from a quarterly reports or from the presentations that companies make, we can come to know about this operating level efficiency, and if it is deteriorating, it's better to avoid those kind of stocks, or if you are invested, to exit from such stocks, because operating factors matter a lot. Then comes the valuation factors that you should look at. See, I'm covering a lesser, I'm not explaining these basic factors in great detail because these are known to public. This is a knowledge domain. You can find this on Google. But if I want to apply these particular factors, we need some technique. That is what I'm going to cover in the subsequent 2 parts. So in terms of valuation, typically what public at large uses is PE ratio, though it is not the only indicator of the valuation. Of late, PE ratio is gaining a lesser importance. So PE ratio is basically, price is how many times of earnings. So I take a price per share and I take earnings per share and I calculate a PE ratio. Instead of looking at the PE ratio of last year or the past 12 months, called the TTM, trailing 12 months, one should look at the forward PE multiple, because the future earnings is what is relevant. Whenever you are investing in a stock or a share, you are not concerned with what profit company has earned in the past. You are more concerned with what profit company is likely to earn in the future. So you should work out a forward PE ratio by taking the current market price and dividing it by consensus EPS, which you can find on Yahoo Finance or various broker websites. So there's a consensus EPS among the various analysts who are tracking that particular stock. Then there is another ratio which is derived from PE ratio called the PEG ratio, price earning growth ratio, which is simply PE ratio divided by earnings growth rate. PE ratio and PEG ratio, both of them basically tell you lower the PE ratio or lower the PEG ratio, undervalued the company is. So I want to pick up or invest in undervalued companies. So I would like to look at the lower PE ratio or lower PEG ratio. But frankly, let me tell you, investing simply by looking at the PE ratio is going to lead to a lot of problems. Don't take a decision only or solely by looking at a PE ratio, or don't be fancy of the low PE ratio stocks. So there could be, I have found out a stock whose PE ratio is just 5 or 7. So let me go ahead and make a huge investment on that particular stock. Not necessarily that low PE ratio will result into returns. Then another ratio which is typically used for banking and the financial services industry, PB ratio. For banking industry, normally no one looks at PE ratio. People look at the price to book value. So bank's book value is basically typically comprising of loans and advances, some kind of fixed assets. Liabilities are deposits and debentures that they have taken. So net book value, I find, and the price that I should pay for that particular book. So you need to understand the valuation for this. Maybe at some other lecture I will cover up the valuation aspects. So what should be the appropriate PB ratio for a particular industry you should look at, and then see what stock you are buying. Is it overvalued or is it undervalued based on the industry parameters? So price to book value ratio. Then dividend yield, dividend as a percentage of current market price. Now, normally during the times of uncertainty or lot of pessimism, stock prices crash a lot. Stock prices do crash. It's like just like you see a sale in a garment store, stock prices or stock markets also have a sale sometimes, but they don't advertise that the sale is going on in the market. So when the stock prices crash substantially without any fundamental change in the profitability of the company or in the operating factors of the company, we should look at dividend yield, dividend as a percentage of market price. Like right now, there are some companies whose dividend as a percentage of current market price is 7-8%. So assuming that the same dividend they will continue in the near future, you can earn 7-8% of your capital by way of a dividend only. But you should always look at whether that dividend is sustainable or not. As a result of coronavirus crisis or this COVID-19, whether the operating level profitability of a company has been hampered or not. For majority of the sectors, yes, operating level has been hampered. So it could result into the lower dividend payouts over the subsequent years because companies will have to spend a lot on capital expenditure in the near future for a variety of expenses. So dividend yield you should look at when two things are there. Number one, there is a crash in the market, and number two, the sustainability of the profit or the visibility of the profit and the dividend is there for the near future. Then this dividend yield makes a sense. Normally, typically in India, dividend yield hovers around 1 to 1.5%. 1 to 1.5% of market price of a share is a dividend yield. Then a better way of valuing a company is enterprise value. Enterprise value is equity value plus debt value put together. Your enterprise value as a multiple of operating profit, that is EBITDA, EBITDA, earning before interest, tax, depreciation, and amortization. So earnings value as a multiple of EBITDA, that multiple also matters a lot because it helps you to do the valuation of an overall business of the company, and then from that overall valuation you deduct the value of debt to arrive at the value of equity. This EV to EBITDA valuation is basically a following of a model that you would have learned in a CA course, Modigliani and Miller. Franco Modigliani and Merton Miller both won the Nobel Prize for a wonderful paper that they had presented on capital structure. So they said that while valuing a company, what you should really look at is operating level profits rather than the net profits. So you take operating level profits and find out what is the total value of the company and find a multiple and look at the historical EV to EBITDA ratio for that company, for that industry, to identify whether the stock is undervalued or overvalued. Similarly, for a startup companies, this price to sales ratio and enterprise value to sales ratio is emerging for valuing the companies which are at nascent stage or initial stages of their business. There are typical traditional thinking is a DCF, which is a present value of what company is expected to earn in the future, discounted cash flow. DCF is nothing but a present value of what company is expected to earn in the future. This is basically a Gordon model of finance. And then there are some industry specific valuation parameters, like in telecom sector, people try to value a company on the basis of average revenue per user, or in a let's say quick service restaurants or quick food restaurants like Domino's or Pizza Hut, people try to value on the basis of sales per store, something like that. You need to find out industry specific factor, or for a retail chain like a DMart, people look at the revenue per square feet that you are generating. So you need to find out some industry specific factors, look at those factors and see whether the company is performing better than its peers or competition, or it is underperforming. And similarly, same company over a period of time, historical comparison and a present. So those are the valuation factors that you should look at. And lastly, among these basic factors, what you should look at is a capital structure, especially on a debt front. See, creating a financial leverage, that is using a debt, is good to maximize return on equity, because on a debt you pay 7-8% and you earn, let's say, return on capital employed maybe of 12 to 14% or maybe 20%. So you are earning ROCE, return on capital employed, of 14-15%, and you are paying an interest of 7-8%. It looks nice that you are earning 7-8% spread or margin, but my friend, remember, debt is a double-edged sword. Debt is a double-edged sword. It's a दुधारी तलवार. सामने वाले को भी खत्म कर सकती है, खुद को भी खत्म कर सकती है. So we need to understand that if there is excessive use of debt by a company, and tomorrow if operating level performance reduces, your debt obligations, that is principal repayment obligation and interest obligation, remains the same. So you could be in a very big trouble. Debt adds to a substantial financial risk to the valuation. So try to avoid the companies who have excessive debt. Now, what do you mean by excessive debt? That will depend on a sector to sector. Like a banking sector, you can't avoid a debt. Banks, financial services companies, they have to have debt. Without debt, they can't work. Money is a raw material for bank. But for other sectors, let's say a company which is operating into the infrastructure sector, or company which is in telecommunication, or company which is in typical manufacturing, the debt is okay, but a reasonable level of debt. Preferably try to invest in the companies which have zero debt or near zero debt, and they have good earnings growth or good visibility of earnings. Because you are eliminating financial risk. So look at the debt to equity ratio, look at debt service coverage ratio, that is ability of the company to repay principal amounts and interest obligations. And interest coverage ratio is only interest as a, whether you have ability to pay the interest or not. So these coverage ratios are amount available to make a payment divided by payment to be made. So debt service coverage ratio is the amount available to service a debt divided by principal amount plus interest amount that is to be paid during a particular period. Higher the coverage ratios, better it is for the company and the investors. And debt equity ratio, lower the debt equity ratio, better for the investors. So these are the basic factors that I looked at. Some other factors that you can look at while making a typical investment is a beta. Beta is typically a measure of volatility in the particular stock price with reference to an index like Nifty or Sensex. So beta is nothing but a regression coefficient of percentage changes in the price of a particular share vis-a-vis percentage change in a Nifty or a Sensex. So it's simply plotting Nifty or Sensex returns on x-axis and stock return on a y-axis for different periods of time. That period can be daily period, can be monthly observations or yearly observations. Preferably, if I take a daily observations of Nifty and a stock, Nifty on x-axis and stock on y-axis, and I plot the points and draw a line of regression, the slope of that line is called the beta. That is a mathematical explanation. But what does it tell you? Beta of an index is taken as 1. If a particular stock has a beta higher than 1, it means it is aggressive stock. Don't invest all of your money into the stocks which have a beta higher than 1. Like banking stocks or maybe infrastructure companies or companies which are more sensitive to the interest rate changes have a beta typically higher than 1. FMCG or pharmaceutical companies, IT companies typically have a beta lower than 1 over a long term. I'm not talking about a short term beta. So try to make a choice of a portfolio comprising of some stocks with a higher beta, some stocks with a lower beta. In, let's say, uncertain times when you see uncertainty over the next a year or so, it's better to go ahead with the defensive stocks like pharmaceutical sector and IT sector, pharma, IT and FMCG, which have historically they have got a lower beta. Then Also try to look at the percentage of pledged shares, whatever shares promoter owns or the other strategic investors own. If they have pledged these shares with the bankers or lenders for the personal loans that they have taken or for any loan that they have taken, you should look at that very carefully, because tomorrow if he is not in a position to repay the loan, or if the price of the share comes down, and that's why the margin that is available with the bank comes down, margin is gap between the loan amount and the value of shares. If that gap comes down, or that promoter is in financial trouble, bank is going to sell the shares in the market. Bank will really not care about at what price they are selling the shares, and there is a huge supply of shares sudden of fall in the market, and that leads to a crash in the stock price. Many companies have, or many investors have suffered because promoter has pledged large percentage of his shareholding. The classic example is Z Entertainment. Now Z Entertainment as such does not did not really had great problems. They were generating good amount of cash. Lot of foreign investors also had shown interest in Z Entertainment. But unfortunately, the other businesses that the promoter had, Mr. Subhash Chandra and his family, the other businesses that they had, SL Group, ESSEL, SL Group, the other businesses that they had into infrastructure or airports or other things, those other businesses ran into a trouble, and for which the shares of Z Entertainment were pledged. Now, shareholders of Z Entertainment suffered because of the promoter pledging the shares of other companies for the loan taken for other companies. So try to avoid the companies where large percentage of shares of the promoters are pledged. And then another factor, while making investment, look at the segment report and try to identify whether the company is dependent on only few products or only few geographies, and that will lead to a trouble. A classic example in the recent times is the Bandhan Bank. This is one of the great story in our country. Bandhan Bank, a bank which migrated from a microfinancial institution to a full-fledged bank. It is only among the two banks which got the license in the last 20 years in the India's, I'll not say last 20 years, last about 12 to 15 years in Indian banking industry, IDFC Bank and Bandhan Bank. This Bandhan Bank was the bank which was earning highest net interest margin, and their non-performing asset ratio or NPA percentage was the lowest in India. But still the Bandhan Bank shares are beaten down like anything in the last 6 months or so, or about 8 to 10 months, especially after the merger of Bandhan Bank with the Grua Finance, HDFC owned company earlier. Now, why? One of the biggest factor that has been dragging the share price of the Bandhan Bank is the dependence of the Bandhan Bank on only few segments, that is microfinance, and only few geographies in the eastern part of India. Only few states contribute to a large chunk of assets under management or the loans given by the Bandhan Bank. West Bengal, Bihar, or those eastern states, 2-3 states account for almost more than 50% of the assets under management for a Bandhan Bank. Even though Bandhan Bank has been a great story, even though it has got wonderful non-performing assets, altogether different lending model, just because the dependence on a certain products or certain geographies has been a big drag on Bandhan Bank. Or another example is a Tata Motors. The European Union or Eurozone went through a crisis, and Tata Motors, which was heavily dependent on Land Rover and Jaguar for their sales and the valuation, also went through the crisis. So try to avoid investing in those companies which are dependent on a particular geography or very few geographies or very few products. Try to look at the companies which have the diversified exposure in that particular sector. You should look at the sector by sector. So this was my first discussion. This was more of a factors that you are done in the chartered accountancy course. It might be recap of various things that you have learned in the chartered accountancy course. Now let me look at some core fundamental factors, and then we go after a technique which you can put to use. Some fundamental factors. This is taken from Motilal Oswal. This is Motilal Oswal every year does a wealth creation study, annual wealth creation study. It is wonderful study during this COVID-19 crisis. If you have got a time to read, go to the Motilal Oswal's website and you will find out Motilal Oswal annual wealth creation studies. Mr. Ramdev Agarwal has presented these studies over the period of time. They're called as, let's say, Berkshire Hathaway of India. I really don't agree with that, but people call it. They have coined it a wonderful terminology here, QGLP. While picking up the stock, they're saying that these four acronyms is what they look at. This is taken up from their one of the wealth creation studies that Motilal Oswal did it. Q denotes the quality of the business and the quality of the management. I wouldn't like to bet on a business which is lagging behind or the management which is lagging behind. I don't want a management which is less competent or which has got the seat in the management just because of being born in a family. They should have a core competence to be on at a management level. So what is the quality of management in terms of ethics, in terms of corporate governance matters a lot. Like right now, a typical example, a hot example right now is a Vedanta delisting from the stock exchanges. The management has basically taken a decision which is not favoring the minority shareholders. It is very good for the promoter because delisting a company from a stock exchange at a predominantly lower prices when the stock price has fallen down substantially is good from the promoter point of view, but it is not good from the minority shareholders point of view. So try to look at the philosophy with which management works. If the management is a management really interested in creating the returns for the minority, because normally as a investor when we invest, we are in a minority category. We are not having a significant influence over the management, or we are not the ones who are having the control over the management. So I want a management which really looks to create money for retail investors. I want to bet on the businesses which are new businesses, which are some emerging ideas, because normally if you look at it, new businesses give you a very very high growth rate. So look at the quality of business and look at the quality of management. Some of these factors are going to come up in my Canslim methodology also. Then next is a growth in earnings, also historical growth and sustainability of that growth over the future. So I want a historical growth rate as well as a sustainable growth rate. Then L, this growth should not be there only for the next 1 or 2 quarters. Growth should be long-term growth. So it denotes a longevity, long-term growth, and the long-term competitive advantage of the company. Basically, you apply Porter's 5 forces model that you could have learned in the management. So you, by applying the Porter's 5 forces model, you'll understand whether the company has a competitive advantage or not while dealing with the suppliers, customers, lenders, government officials. So does a company have the competitive advantage? And that competitive advantage should be over a longer time frame. And P ultimately denotes the price which you pay for buying that particular stock. That is a valuation factor. QGL are basically fundamental factors, and price is what you are paying right now. Denotes that the price that you are paying for buying a good business. What they say is P denotes the approach of buying good business for a fair price. Buy a good business for a fair price rather than buying a fair business for a good price. Try to do a bargain hunting. Many a times the stock market comes up with the sell. Now, if you look at the last 3-4 years, 2018 when the ILFS crisis hit Indian markets, many stocks were available at a substantial discount during Diwali 2018. Then market bounced back after the corporate tax rate cut was done by the Nirmala Sitharaman, and that rally continued until the budget of 2020, and thereafter everything fizzled out. But market gave you a lot of opportunities for doing a bargain hunting or bargain buying at that point of time. So you should try to buy good businesses for a fair price. So this QGLP you should look at. Then there is one simple matrix that I've done. This is taken from one of the portfolio management service. What factors they look at while deciding onto a particular stock? Number one, financial factors, which typically I talked about earlier: return on capital employed, return on equity, growth rates of your profit, sales, and the cash flow generation. That is your P&L balance sheet, financial statements. So look at the financial statements. Those factors will tell you. You should develop your own yardstick as to what ROE or what ROC is good enough. That is why it said ये क्या है ना, ये knowledge है. इसको यूज कैसे करेंगे? इसको यूज करने के लिए मैंने एक टेक्निक आपको बोलने वाला हूं. That is a Canslim methodology. Then the next factor is opportunity or the moat size, we call it as exponential sector growth. The sector in which that company is, that sector should also grow at a fastest possible rate. The company which you are investing should be the leader of that particular market, and that company should have the bargaining power with the customers and suppliers. Then the moat is opportunity. The opportunity size should be big enough. Just there is an opportunity, but if that opportunity size is not big enough, there is no point. Look at what Reliance Jio has done. They have ventured into telecom business, right? There was an opportunity, but the size of the opportunity is so big because the telecommunication sector in India was not penetrated. We did not have a penetration of data at rural level or tier 2, tier 3 cities. And what Jio has done is it has uh, put the data in everybody's hand. How the people are using is a different question altogether. But moat size. Similarly, I personally look at the banking business in India because credit loans as a percentage of GDP, personal debt as a percentage of GDP is pretty low in India. So credit growth which can happen in India is exponential. So if I look at the total personal loans that are taken by the Indians as a percentage of economic activity that we do as a nation, we find a much lower credit penetration of a credit. In the foreign countries, if you see over a period of time when the economy has grown to a levels of $5 trillion or and above, the credit has grown exponentially. So I personally see that the good growth coming up in the banking and the non-bank financial sector, not immediately. Immediately, people are not willing to spend due to the coronavirus crisis. People are holding on to their spending. But see, everyone, we will, as a mankind, as a community, we will overcome this crisis in a matter of maybe 5-6 months or a year or so. In the next year, our habits would undergo change. But it's not that we are going to be in a social distancing mode or lockdown mode for next 20 years or 50 years. Maybe next 1 year, next 2 years, we could be in a situation where we may have to maintain a better social distancing, and it is better for let's say everyone. But growth or the positivity or the enthusiasm among the businesses will come. So I need to find out the sector which has a huge moat size, opportunity size, and then the management should also be qualitative. What you should try to avoid is a companies with excessive amount of debts higher than the industry levels. Government companies, because in case of government companies, government really doesn't care about the minority investors. Government takes a decision on their own. Like take a classic example, State Bank of India making investment in Yes Bank. It was more kind of a political decision. Which private sector bank would have invested such a huge amount? Yes, other private sector banks have invested, but they didn't invest as much as State Bank of India invested. So government takes a decisions which are not favoring the investors. Government takes a decisions on their own, sometimes political decisions or sometimes driven by other factors. So try to avoid government companies as far as possible. Weak price action, companies which are showing the weak price trend, try to avoid. That is a technical indicator. Try to avoid it. So how do we spot the value in a particular stock? Try to look at the companies which are having a cyclically low earnings at present. So once the economic recovery takes place, these companies will start showing the good earnings. Try to do the valuation of the different parts of the businesses, called the sum of the parts valuation. Like Reliance Industries is a company on telecoms play, retail industry, and oil and chemicals business. So oil and chemical plus telecom plus retail put together is a total valuation. So try to see whether the total valuation is less than the sum of the parts. So individual parts you do valuation and then do the aggregation. Sometimes you may find that there is undervaluation taking place at an aggregate level. This does happen. Many a times it happens. Like there is a holding company and it is owning 3-4 subsidiary companies. Logically, the value of the subsidiary companies put together into the percentage stake owned by the holding company. So I am holding company, I am owning 70% of a subsidiary. Logically, the market value of subsidiary company multiplied by 70% minus the income tax that I have to pay on a capital gain should be the value of a holding company, assuming no other business in a holding company. But it doesn't happen. It doesn't happen all the times. So sometimes you may find a value where a holding company value is not in synchronization with underlying businesses, or the total value of the business is not in a synchronization with underlying business value. So try to identify that particular trend. Look at the other factors like higher dividend yield, enterprise value. I discussed those factors earlier already. Now I go to my next section, which is how do we put this entire knowledge to the use. ये जो factors हमने discuss किए, ये सब किए, ये हमको use कैसे करेंगे और how do we ultimately take a decision? A simple technique that I am discussing, it's a technique launched by William O'Neill, a investor, legendary investor. They have a service in India called the Market Smith India. So they run this particular data. It's a basically decision being taken on the basis of data. So what factors they look at, and then they release that data on their website. Some data is available freely, some data is available as a paid user. Or depending on what kind of investor you are, you can look at these factors. So there's Canslim is an acronym. C stands for current quarterly earnings. So short-term earnings. A stands for annual earnings growth. So that is more longer term. So you look at the profitability. C and A are talking about profitability. So 25% or higher earnings growth should be there in the recent quarter is what they believe in. Preferably try to invest in the companies which are accelerating EPS growth. That is, EPS growth should be increasing quarter on quarter, because then only institutional investors are going to be attracted towards the company. So if a quarter on quarter your profits are increasing, then only institutional investors get attracted. So look at a quarterly earnings growth rate. Then look at annual earnings growth rate, because quarterly earnings growth rate can be managed by making accounting adjustments. You can make a typical accounting adjustments, cut down the cost in the short term and show a good performance in a particular quarter. But over a longer term, do you have good growth rate in earnings year on year? So you want to see annual earnings growth of at least 25% in each of the last 3 years. So you should be, I'm trying to invest in companies which are growing at approximately 2.5 times of nominal GDP growth. Nominal GDP growth of India is 10 to 11%. Forget this year. This year is an exception. 10-11% is a long-term nominal GDP growth that India has. So I want to invest in a company which grows at least twice the growth rate of economy. I don't want to bet on a company which is lagging behind the economy or which is just in line with the economy. Economy is growing at 11-12%. So I want a company which is growing annually at 25% plus, and return on equity should be higher than the 17%. That is what I told you, a thumbnail or thumb rule. Short-term earnings may be managed by cutting down on the cost. That's why you should look at the long-term earnings. So look at the C, look at A. Then look at N. That is new products, new services, new management, or a new price high that a company is making. Because everyone looks for something new. Everyone looks for something new. The greatest stock market winners showed that 75% of them are the companies which have gone public in the last 8 years. So market always keeps on looking for newer trends. So maybe right now, if you look at companies, the investors in the last 2-3 years have looked for e-commerce platforms or platform-based companies. So if you look at across the world, companies like Netflix or company like Facebook or Amazon, FANG stocks or Google, Microsoft, or in India, if I look at InfoEdge, Naukri.com जो website चला था वो InfoEdge है. So InfoEdge, or look at IRCTC for that matter. These are basically platforms. They are creating a platform and then trying to gather the customers. So I want to identify the companies which are new in the trend. So I want a new product, new service, new management, new price high, something new. There has to be something new. I don't want the companies which are traditional ones. See, if you see, there are traditional companies, but among the top companies, if you see, the traditional companies are quite few. Look at the biggest wealth creator in the last 10 years in terms of percentage has been the Bajaj Finance. It's an NBFC. There was no Bajaj Finance 30 years ago. There's no Bajaj Finance in terms of stock market. But Bajaj Finance has created a huge wealth because they have followed a different model of no cost EMI. No cost EMI is what they have promoted. And it resulted into a huge benefit for the Bajaj Finance. It made the consumer durables financing very easy in our country. So look for something new product. Look for demand and supply. This is how quantity, volume of the shares traded. Look for a heavy volume accumulation, that is buying by the institutional investors, particularly in the key moments when the stock price is forming or breaking out of a particular pattern. So look at the accumulation by the institutional investors or look at the selling by institutional investors. That is S, supply. Then L is for leader or a laggard. Whether the stock is a leader in terms of price or is lagging in terms of price. This is a technical indicator. So top rated stocks within the 40 to 50 industry groups you should look at. You should look at, there is a relative price strength index. You should look at the RSI of about 80 and above. Relative strength or rising relative strength line should be looked at, and try to invest in the leading stocks rather than lagging stocks. And then I stands for institutional ownership, like mutual funds, pension funds, foreign institutional investors. Look at the ownership by the institutional investors and the changes that have taken place. And finally, in this M is market direction. What is the current status of the market? All those factors could be good. You can have all earlier 6 factors lined up nicely. But if the overall market is in downtrend, there is no point in making, there's a very less probability that you will make a money. It will be very hard to make a money and beat the market. So their study shows that 3 out of 4 stocks follow the trend of a market. So you will always like to be trend in synchronization with the what market is. So if a market is giving you a signal that it is in bearish mode, try to hold on to your investment. If the market is signaling a huge breakout, then you can go ahead and make a investment in a staggered manner. So basically, this leads us to the 2 simple questions: what to invest in and when to invest. What to invest is basically stock screening. The first question is the stock screening. So for the stock screening, I'm giving you, on the basis of this Canslim methodology, I'm giving you certain ratings, 3 or 4 factors, and that's it. Then I'll end up my discussion and I will take a question answers. The first factor is EPS rating for doing a stock screening. Earnings per share. So try to rate the stocks on the basis of their earnings per share growth rate in the past, earnings per share compared with the other industry players. This entire PowerPoint presentation is available in a description at the right now. I think Chaitanya would have put up the link in the description already, or you may find it at the end of the session. So you can go through this entire methodology, and if you want additional details, you can always send a WhatsApp message to me. So you try to put all the stocks on the basis of the EPS growth rate and rate them from a scale of 1 to 99. Now, instead of you people doing this entire working or exercise, MarketSmith app, they have Android app or the Play Store, this iOS app or website also, you'll find out the ratings out there. So try to look at EPS rating of the company on a scale of 1 to 99. Usually try to prefer the companies with the EPS rating of 80 and above. So look at the first EPS rating, earnings per share. Then second factor to look at is price strength of the company. So price strength is calculated on the basis of weighted average performance of a stock price in the last 12 months, because I want to invest in a company which is showing the strength in terms of price. If the price is not showing the strength, that means there is some problem or market perceives some problem. Even if you don't think that there is a problem, market is perceiving that there is a problem. So try to respect what market tells you. So look for ratings again from 80 and above, that is price strength rating, EPS rating and a price strength rating. Then try to look for buyer demand. Is there is a accumulation of the stock by the institutional investors, or whether the institutional investors are selling the stock, that is called the distribution rating. So they rate the stocks on the basis of A to E. So A is called the best buyer demand rating and E is the worst, where the distribution is taking place. Look for buying a stock with the C or higher rating, C or higher. Then the industry in which that stock is. So we talked about the 3 factors so far: EPS rating, price strength rating, and the buyer demand rating. And the 4th factor is a group strength. Group is industry. Totally all the listed stocks in India are divided into the all minor industries. There are total 197 industries. If I try to break down all the 6,000 stocks that are listed on the BSE plus NSE put together, actively speaking, around 3,000 stocks are there. So 197 industry groups are there. Big winners and leaders in the past are mostly belong to the industry group that is doing well as a whole. So rather than just looking at a particular stock initially, try to filter down at an industry level. And there is a ranking of all the industries done by the Canslim methodology or Market Smith. You can visit their website after the session is over. You'll get a lot of good insights. 1 to 197, try to look for the rank of 40 or better at a current point of time. So whether that industry is in favor or not at the current time when you are making investment or from a long-term perspective. And then based on this EPS rating or buyer demand rating, price strength rating, and a group rating, there is a master score which is determined by applying the weightage to each of the factor. Look at the master score of B and above. All these is available at a website of Market Smith India. And finally, my last slide is investing in uncertain times. I'm just putting down to one slide. This is the last slide. Then we are open for the question answers. So when you are making an investment during these uncertain times, what factors you should look at? I'm making a simple summary for investment philosophy. I should look at the companies which are growing at 1.5 times to 3 times of GDP growth rate. I don't want to bet on the companies which are growing slower than the economy. Bet on the companies which are growing at 2x, 3x of a GDP. Look at the companies which have zero debt, because right now I don't want to invest in a company which has a heavy debt obligations. So along with the operating front problems, you will have financial problems also. So operating front is in trouble and financial front also is in trouble. Both of them could lead you into great problems. So look for companies which have zero debt. Look for companies where owners have the skin in the game. Owners, the promoters of the company, should be the ones who are not cutting down their shareholding. They should be going aggressive on their shareholding. They should be willing to make an investment. Like look at the Reliance Industries, where the promoters have said that they are willing to subscribe for the entire right issue, even if it is unsubscribed. So right issue is opened by the Reliance Industry. 20th of May, it is going to get opened. So promoters have said that we are willing to invest. So promoter is coming forward and making investment in the company. He is not afraid of making investment in the company. Look at those kind of promoters who have the skin in the game. They are investing a large chunk of their money into the company. And low drawdowns. Drawdown is basically percentage fall in the price of the share from the high that it has made. Try to make an investment in those companies which have shown the low drawdown, that is decline from the high levels, and the companies which have recovered very quickly from the lows. You will find out typically large caps are the ones which have a very low drawdown and then they recover faster. So based on this, the asset allocation that I find logical at this particular point of time, which you can achieve through the direct stock investment or through a mutual fund route also, whatever the route you want to opt for. You can look for exposure to the large caps of 60-65%, mid caps of 20-25%, and debt of around 10-15%. I'm looking at an investment time horizon of 7 years and plus. So from that particular time horizon, I personally don't see a big problem in Indian economy as such, because see, the issues are short term. Short term troubles should not decide our decisions for longer term. So I thank you for the patient listening. Now I take up some doubts. There are a lot of doubts that have come up. Oh my God, kitne doubts hai? Huge number of doubts. There. Some people have come down to the good morning and other things. So obviously, I'll not go ahead with those doubts. So let me just look at the wonderful doubts. Sumit Shah says, sir, what is your take on NBFC and financial institutions? Personally, I think top quality NBFCs will only survive. Majority of NBFCs, the froth in the system, especially after demonetization, what happened was banks got a huge amount of liquidity. Banks got because the entire cash came into the banking system and the banks went on lending to the NBFC sector. and NBFCs went on doing a reckless lending. But there are some NBFCs, good quality NBFCs, which lent on a smaller ticket size. The NBFCs which lent on a diversified geographic region, those NBFCs, large cap NBFCs, I expect to survive good. To name a few, I personally think Bajaj Finance, Muthoot Finance, Manappuram, Muthoot and Manappuram basically because gold prices have increased. Muthoot Finance and Manappuram Finance both are gold finance companies. So gold finance companies, because the gold prices have gone up, so collateral that they have has increased substantially, so chances of bad debts are lesser. So I personally think NBFCs, number of NBFCs that are there in the industry, majority of them would be wiped off. The quality NBFCs will remain. I'll just tell you, the credit growth or the penetration that we have in our country is much, much lower as compared to the western part of the world or the developed part of the world. So NBFCs positive, but not in a short run. Government of India in the first fiscal package has announced some good lending to the NBFCs. RBI has also come forward to protect the NBFCs. The problem with the NBFC happened because of Franklin Templeton fiasco. NBFCs ka large chunk of financing or 20-25% financing takes place from mutual funds. But due to the freeze in the some of the credit risk funds run by the Franklin Templeton, NBFCs have got problem in terms of getting the money. But that problem will also get solved as RBI is pushing more liquidity into the system. So look for good quality NBFCs. So Ruchi soya stock, no yaar, I don't want to comment on the stock. Ramdev Baba has taken it. See, Ruchi soya might have been taken by Ramdev Baba, but Ruchi soya earlier did not had a good track record, so I won't like to comment. Sarvesh Joshi sir has asked a wonderful doubt. How many points would you give to the destiny that plays in one's life in case of investments, both short term and the long term? See, during the current times, I will say destiny has played a great role with the public. But when it comes down to investing, yes, your destiny, your luck also plays a very important role. I'll say 10-15% goes to the destiny. It's like a chartered accountancy course examination also. You study a lot, but still thereafter, your luck in terms of what examiner would do or what kind of paper would come up affects the performance. The same goes for investing. But we can't really be boggled down and remain, let's say, away because the investing is a very risky phenomenon. So I'll give 10-15 points to risk. Any viewpoint on the pump industry? More than the pump, I'm looking at the piping industry, or because whatever agricultural reforms are announced by the Modi government day before yesterday, they are announced good reforms to ensure that the farmer's income is doubled. And really, after coronavirus, I see a lot of migrant workers going back to their villages and resorting to the agriculture. And if government really pushes for the agricultural reforms, what market reforms that they announced, and those reforms are executed nicely, I see agriculture and agriculture allied industries, maybe pump industry or maybe a piping industry or maybe irrigation industry or maybe fertilizers or some chemical companies could do very well going forward. So Jain irrigation is a fraud, so don't look at the Jain irrigation. Jain irrigation is in big trouble. Yes Bank is in trouble. Do not try to look at the companies which have trouble. See, Yes Bank, you might look at our share price bahut kam hai, Idea Vodafone share price bahut kam hai, but those companies will give you a lot of trouble. Try to avoid those kind of companies which have shown some trouble. So how do we know when the timing is right for the investment or not? I'll tell you one wonderful method. If you go to the markets, Smith, it's a wonderful doubt that Mr. Rohan Dalvi has asked. If you go to that Market Smith app, there is something that they call as market status. And historically, this is a data of about 100 years in the United States, Dow Jones. So they have created the status, market status confirmed uptrend, then they have a rally attempt, confirmed downtrend, or the neutral. Like this, there are status of the market. So if you visit Market Smith India app, based on the trading that happens and based on the global market position, there is something called the market status. So you can look at that market status in Market Smith app to understand whether it is a good time to make an investment or not. It is based on the data. It's obviously, as Sarvesh Joshi sir was talking about, luck plays an important role also. So you could go wrong in terms of timing also, but something is better than nothing. So there is one doubt about Indian tobacco companies. What do you think about ITC? In my opinion, ITC will do well. ITC over the years, under the great leadership of YC Deveshwar, has transited from a tobacco based company to an agriculture company or a consumer driven company. The investments that ITC has made in the last decade or so in consumer FMCG division and agriculture division are yet to give the fruits to ITC. So far, even today, the about 65-70% of the PAT of ITC comes from cigarette business or tobacco business. Cigarette business is prone to the government policy. Government is going to do excessive taxation, but the loyalty that the customers of tobacco products have to the product is huge factor. So irrespective of what price or what taxes government puts up, cigarette volumes have not dropped substantially. Growth rate of cigarette business or tobacco business has slowed down in ITC. I agree on that, but the volumes have not come down dramatically. So ITC cigarette business is helping them. Plus, I personally believe consumer goods business of ITC and agriculture business of ITC will give a good return. So I personally believe ITC is perfectly valued at 160, 170 rupees right now. So ITC is a good thing to go ahead with. Then, sir, your comment on the PVR. I would like to avoid companies which require mass gatherings. PVR will be in a great trouble if social distancing norms are extended over a long term. And what trend we are seeing right now, there are certain movies. Amitabh Bachchan has made a tweet day before yesterday. I don't remember the name of the movie, but that movie is going to be launched onto digital platforms like Netflix and Amazon Prime or whatever. Some platform is there. So if the new movie launches go onto these OTT over the top platforms, who will go to the cinema theaters? Public has right now understood in these 2 months of coronavirus period that watching a movie at home is also a good experience. Though PVR offered a great experience to the users, PVR coming back to the normal levels where it was will take a time. So I would like a PVR. PVR is a good company. I would like a PVR, but only when this entire coronavirus or social distancing norms are subsided. Or because see, even if the let's say these theaters are open, they will be open with the social distancing. So out of the 3 seats, you will be giving only 1 seat. And if you try to increase the price, then it will be affecting. So affluent section of the people is what PVR used to have. They will avoid PVR. So I'll really not look at the PVR right now until everything goes normal.
Hello,
So
sir. Sir,
there are a lot.
can I
Yes.
come in
Yes.
between? Sir, there
Yes.
are lot of
Lot of
comments.
doubt.
Yes, and they are share specific. So instead of
Yes.
share specific, can we take the general comments first because
Yes,
it will
general,
go
but
on the
can you
share
filter down?
specific doubt.
Can you filter down
Yes,
2-3 comments? We'll take a 2-3 comments
yes, sir. I'll just filter. Sir, there was
because
one question wherein he was
huh.
asking how to check whether the management is performing good or bad. How do we
Okay.
check that?
Okay. So for management efficiency, there are 2-3 factors which you can look at. Number one is operating level efficiency, as I talked about, your asset turnover ratio or your debtor turnover ratio, number of days within which you are collecting money from your debtors, inventory turnover ratio. On overall basis, operating cycle is one very important factor which tells you whether the management is efficient or not. Number of days of operating cycle, if they are coming down, it gives an indication that yes, operating cycle is performing, management is doing good. So number one is operating cycle period, and number two, ROE, return on equity. If that return on equity is growing, good. Third factor that I look at is economic value added. If the profit after tax is more than the cost of capital employed, or net operating profit after payment of taxes is more than the cost of the capital, providers of funds, they expect X return. But if management is earning more than that X, that is positive economic value added, I will go ahead with that particular stock. Chaitanya, you are able to find out some
Yes,
good. You
sir.
can
There
tell me
was
because
one more question.
I'm not reading
Yes,
the doubt regularly. That's why I'm just
yes,
seeing the last doubt.
yes, sir. Sir, there was one more question wherein the viewer was saying that the even after looking at the factors, there is still an emotional background to the share. So, how do we invest then if there is an
See,
emotional background?
emotional background, luck, destiny is going to matter. Your emotional quotient is going to matter. If you see over the number of years, rather than active investing, passive investing is growing like anything. In our country, it has not grown to a large extent. But if I look at the US history, in US, passive investing has increased, whereby you just keep emotions aside. You say that I have 20,000 rupees to invest every month, I have 50,000 rupees to invest every month. Put this 50,000 rupees into a index fund, maybe S&P 500 or maybe Nasdaq or maybe Dow Jones. So like this in India also, this culture of passive investing is coming up. So in my opinion, if you have a lot, if you are attached to the emotions or something like this, you are a very emotional fellow, or you are looking at luck or other things, try to avoid direct investing. Go for a passive investing. Sarvesh Joshi sir ne jo bola tha destiny factor, it plays a very important role. So you try to avoid that particular destiny. Just look at index exchange traded fund or a passive investing. In India, I personally find Nifty ETF or Nifty Next 50 ETF to be good. If you want to keep emotional side aside, just say 10,000, 20,000, 30,000, what, or 5,000, 1,000, whatever the amount you want to invest, go ahead and make an investment in the index ETF. All your emotions will be kept aside. These are the days of algorithm trading. These are the days of automated trading. So look for a passive investing if you are emotional fellow. Chaitanya, you
Sir,
can come up.
yes, there is one question. Can you recommend some good books for market beginners? And second thing, can you also repeat the website you mentioned for statistical ratio?
Okay. So good book as a stat to begin up with. I will say number one, value investing ka book hai by Benjamin Graham, The Intelligent Investor. It's the book on investing. Intelligent Investor is what you should begin up with. And once you are done with that, then you should go ahead with the certain books by Aswath Damodaran on valuation. How to find the value of the company. This is a professor with New York Stern University, Aswath Damodaran. You will find out these books onto the Amazon very easily. So go ahead with the Intelligent Investor and Aswath Damodaran's books on valuation. And on passive investing, I will suggest John C. Bogle, the person who pioneered this concept of passive investing across the world. Is a founder of Vanguard Mutual Fund, Mr. John C. Bogle. So go ahead with the books on John C. Bogle. That is the books. And the second point was the websites for this Canslim methodology, which I talked about. The website is Market Smith India. You just Google search marketsmithindia.com. It could be a .in, whatever. Market Smith India. And other website, screener.in and ticker tape. Screener.in, Market Smith, ticker tape, Stock Edge. These are some good platforms, will give you good enough data to play with. At least in case you are not investing or you want to try out, these websites will give you good insights.
Sir, there is
Yes,
one
Chaitanya?
another question. Graham and Dodd have stressed that value investors look at potential growth only in
Correct.
exceptional cases, but all investors keep stressing on growth. What is your take on that?
I will personally take on growth completely. Graham Dodd, Benjamin Graham was basically a teacher of Warren Buffett. They stress too much onto the growth. See, growth is a life, weakness is death. That's what Swami Vivekananda said. That applies to a personal life, that applies to a financial life. Why would I like to invest in a companies which are lagging behind than the GDP growth rate or lagging behind the industry? So you should try to invest in the companies which are growing only. Yes, in exceptional circumstances, a company might be growing lesser, but the future growth may be good. So that case, like Reliance Industries prior to Jio Infocom or Reliance Retail uh, came out to in a true spirit, Reliance growth rate was comparatively lesser. So that point of time, Reliance was look good. But in general, I want to look at the companies which have demonstrated good growth in the last 1 or 2 years, or have a likelihood of demonstrating a good growth going forward.
Yes,
Yes,
sir.
Chaitanya.
There was one question as you discussed about the falling of Bandhan Bank. The viewer is
Yes.
asking what is the reason for the falling of IDFC Bank share price?
Okay. IDFC Bank fell down primarily because it did the merger with the Shriram Capital First NBFC. So Capital First NBFC and IDFC Bank, both of them, the merger didn't go as expected on a short run, number one. And number two, very important reason, IDFC Bank is not focused onto retail deposits. It's more focused onto the corporates. Now the corporate cycle or the corporate spending or the corporate growth in India has been muted for the last 4 or 5 years. But IDFC Bank management is extremely good management, no doubt about it. The management that they have got from the Capital First also is a good management. So IDFC Bank has fallen primarily because it was more focused on corporate side, and the corporates as such last 5 6 years have not really grown. So, and that's the reason why IDFC has fallen down. But IDFC, if it builds up the CASA ratio, current account savings account deposit ratio, which they are trying good in the recent past, their CASA ratio has increased substantially. So if they build up on a good CASA ratio, IDFC will be able to do good.
Sir, there are lot many questions, but
Lot
I
many
think we
questions.
take last 2 to 3 questions we can
Yes,
take.
yes,
Yes.
absolutely up to you.
Yes. So one question is, which sectors are likely to be focused in post-corona period, or which sector will lead the market?
In my opinion, the sectors that will lead are number one, platform-based companies. Company like InfoEdge or company InfoEdge was a platform for recruiting people or for marriages. It's a platform. So the companies where I want to have a very very minimal operating cost, I create a platform. The platform is business model I create, and I invest on that particular platform, and it keeps on giving me the returns over a period of time. So those platform based companies, e-commerce models are the ones which I expect to do well, number one. Number two, I expect consumer companies to do extremely well. Like a company like HUL or company like ITC. HUL was extremely good buy. Last week, GSK sold about 23,000 crore rupees of equity in HUL. So HUL is a good buy because it has a great portfolio. It is backed by a MNC leader. It has a huge cash flows, operating cash flows, no debt at all on the balance sheet. So look for those consumer companies or FMCG companies with a great cash flow visibility in the going forward. That is consumer staples. So platform-based companies, consumer staples. And the third thing is an aggressive bet, in my opinion. Third, on a defensive side, pharmaceuticals will do good. Pharma has not done well in the last so many years, but pharma is back to the stage now again. So pharma will do good. And the last bet that I want to big, which is aggressive bet, is an FMC, NBFC companies, quality NBFCs. So like maybe like a Bajaj Finance, Muthoot, I talked about. So quality NBFCs will do good because see, Indian banks cannot cater to every household. This is a bottom line. Indian banks cannot go to the last mile. They cannot, like a person who has not filed the income tax returns for the last 2 3 years, or a person who is a daily wage worker, or a person who is driving auto rickshaw, or a person who is a typical middle class household. When he goes to the Indian bank, any bank, maybe private sector bank or a public sector bank, banks will have typical checklist. I want a 3-year IT return, I want a salary slip, I want these details to be eligible for a loan. So loan growth is very essential for economy to grow. But I will look at those NBFCs which have quality management. I will not look at something like India Bulls, whereby everyone comes across and anyone comes across some sudden of all and makes a appeal in the Supreme Court that there are frauds in the company, something like that. I will avoid those NBFCs. So quality NBFCs will thrive back, not immediately in the next 1 year, but going forward, yes, they will thrive back. And IT company defensives first, good one, and then bank financial services, NBFCs. Yes, Chaitanya.
Sir, there is one really good question. So, what are the your thoughts about exit from investment as well? Like, what are the factors which signal you that you should exit from that investment?
Good. So once you have made an investment and you made a good amount of profit, what will really make you exit from the investment? 2 3 factors. There's a peaking out of a growth. Like I'll give a classic example: Maruti Suzuki. It those students who were in 2018 batch, I had shared the entire analysis of Maruti Suzuki with them at that point of time. Maruti Suzuki peaked out in terms of price of almost 10,000. So company which has done a fantastic stellar run in terms of earnings growth, in terms of share price growth, in terms of industry leadership. Once it has achieved a phenomenal growth over a particular longer term of 3-4 years and it peaks out, it's a time for you to take away certain amount of profit. The trigger for Maruti Suzuki was metro trains coming up. So more and more public transport at that point of time. I think now that will go against after the coronavirus again. God knows whether people will go for the private transport and run away from a metro. So the factors that ran against Maruti after peaking out was, number one, metro train coming up. Number two, these Ola or Uber kind of services coming up, and people or young generation trying to avoid the ownership of a car and going to the rental model. So those are the factors. So try to identify the peaking out in terms of the volume growth, in terms of earnings growth, in terms of share price. So once you see the growth tapering down, see, growth will have a peak, and then if the growth starts slowing down or maintaining, that is a time when you should take away certain profits home. And
Sir,
obviously the
so
triggers like fraud, like some triggers like immediately ILFS came out with a certain trouble in management, or Manpasand beverages came out with the fraud, or there was one company from this, I forgot the name of this company. This was a very agriculture oriented company. It's a huge fraud that was noticed in this agriculture driven stock. Wakrangi, I got the name, Wakrangi. So as soon as you see a fraud kind of thing coming up, or auditor doing a resignation, or some kind of issues on corporate governance, try to exit from the stock immediately. If you see a corporate governance problem, you see some kind of a fraud, you see some kind of industry trouble coming up, just exit.
sir, as you said that people may not travel by the metro or bus. So, can we risk now investing in automobile sector?
That is a very big call. In my opinion, yes, automobiles should start doing good again, because in a short run, at least public will be afraid of traveling by public transport. And see, already India's public transport system was not able to cater to the entire community. We used to always have full buses. Now the size of the buses or the trains that we used to have right now, so prior to corona, if that continues, corona will spread like anything. So I personally think that people will bet on automobile space, but within automobile the growth would be more in two-wheeler segment, because two-wheeler is more affordable. See, the public which is using public transport, or the like buses, trains, they are more likely to transit towards a two-wheeler rather than the four-wheeler. So I will look for a two-wheeler space. Within two-wheeler, the affordable segment of two-wheeler space, maybe entry-level models, what Hero provides or what Bajaj provides. So I think that should be a good bet.
Okay. Sir, there is one question. How much one should have global exposure in the basket, percentage of total investment?
See, global investing is really very tough on a direct front as an investor from India, because our Foreign Exchange Management Act and the other regulatory environment is very, very complicated even now. So for a global exposure, the best choice is mutual funds which have exposure to the global stocks, especially United States. So I personally think 5-10% of the exposure is good. That too in the US stock, US IT stocks. Nasdaq is what you should look at rather than Dow Jones and S&P. S&P is more towards the financial services. Dow is more towards manufacturing. Nasdaq ETF, there is a certain funds by Motilal Oswal and Parag Parikh mutual funds, but Parag Parikh does not have exclusively towards Nasdaq or international investing. Motilal Oswal and Franklin Templeton, they have some funds which are oriented towards this Apple, Facebook, Netflix, Amazon. These are mighty giants. These are not going to fall down because they are too big to fail now. A company like Apple, Amazon, Google, Netflix, if they fail at this particular level, it's going to be a big, big trouble, because they are established business models now and they've got a huge, huge cash flows with them. They are cash rich companies. So, like the day before yesterday, only the news came up. Jeff Bezos is going to be the first trillionaire in the world by the 2000, let's say 22, 23. So, US stocks, Nasdaq, you can look at by way of a international oriented mutual fund of Motilal Oswal.
Thank you, sir. Sir, there is
Thank you.
one question.
Yes.
How do we keep ourselves updated by the investment shares related news?
Okay. See, the basic thing that you need is a 2-3 good news reporting uh, applications on your mobile phone. Any 2 3 applications that you should look at, maybe something like Economic Times, Live Mint, or something like a Business Line. So 2 3 news applications is what you should look at, number one. And number two, very important, beyond news, because news will just tell you this is the information. News will not tell you the analytics behind it. So you should subscribe to some good magazines. Now that I'll not give any specific list as such, because list is wide open. You should look at some analytical magazines or portals. Like, maybe if I want to name a few, maybe something like ET Prime at a easy affordable level, Economic Times Prime, so they are doing good analytics into the various business models, or Bloomberg Quint is there. So some news based applications and some analytical based applications or magazines is what you should subscribe for. Another platform where majority of these magazines are available at a very cheap cost is a Maxter. Magzter. Maxter is an application, it's a newsstand kind of concept, which allows you to subscribe for the large number of magazines through one application. So you can subscribe for such kind of magazines. But in my opinion, 2 3 news applications with the ET Prime and Bloomberg Quint should also do well for any normal investor. And then keep tap on, let's say, Twitter. Follow certain Twitter handles, very important, because nowadays the information has gone from a large written text or essays or reports to a 140 characters or 280 characters, whatever Twitter permits now.
Sir, any specific Twitter account you would like us to follow?
It's a huge list. It's a huge list. It's a huge list. You just go follow any particular Twitter. There are a lot of information. Try to restrict it to, in my opinion, about 5-10 handles for investing. 5-10 handles is more than enough to go ahead with. And try to avoid the derivatives trading completely at the beginning level. Try to look for more of direct investing in quality companies or mutual funds rather than derivatives. Don't try to follow the derivatives handle.
Okay, sir. Okay, sir. Last
Thank
two
you.
questions, I
Yeah.
think, because
Yes.
it's time now. So, how
Yeah.
to
Yeah.
manage size of position in any particular stock, and how much stock should be added in portfolio?
See, in my opinion, 8 to 10 stocks is good enough. You should not try to have, let's say, 30-40 stocks in a portfolio. 8 to 10 stocks and about 3-4 mutual funds is good enough in a particular portfolio. And if the size of the portfolio is increasing substantially, don't try to increase the number of stocks. Try to go ahead with the same stocks and do incremental buying. So if initially you start with the 5 lakh rupees, and let's say over a period of time you go to the 50 lakh rupees or 5 crore rupees, does not mean at a 5 lakh rupees you had 4 stocks and now 5 crore, you do cross multiplication. 5 lakh is equal to 3 stocks, 5 crore is equal to how much? That cross multiplication doesn't work. So even if your size increases, try to make an incremental investment into same stocks on which you have a full-fledged conviction. And in uncertain times, or let's say you see a turbulence going ahead in the short term, you may try to hedge the portfolio through the derivatives, maybe like buying index put options in case the size of portfolio is substantial. Index put options can help you to hedge, but that too, if in case you have a portfolio which you expect to materialize in the next 2-3 years, and you expect a good chunk of problem in the next 1 month or 2 months, then you can maybe monthly expiry put options is what you can look at. But size of portfolio should be managed by keeping the stocks lesser, buying few stocks where you have a high conviction. Those high conviction stocks, it's like a marriage kind of that you are doing with the stocks. Only thing is you are allowed to have multiple marriages here, and you can have a divorce at any point of time.
Okay, sir. Sir, last question for the day.
Yes, Chaitanya.
What do you think? Why do you think Reliance is raising money so aggressively in these times? What, in your view, could be their big plan?
In my opinion, Reliance's big plan is get rid of the debt. The biggest plan in that Reliance has, first get off the debt part, number one. Once the Reliance removes the entire debt from the balance sheet, because the reason why Reliance was stuck in the range of 750 to 800 for a very large part of the time was the debt overhang. Reliance had almost a debt at a consolidated level of 3.5 lakh crore rupees. So that debt they want to get rid of. So if you see the investment by Facebook or let's say that other private equity investors, Reliance has basically used a large chunk of that money to repay the debt. So Reliance big plan is get away from debt, number one. And number two, once the debt goes off, your valuations will really improve. and at that improved valuation, making let's say doing a dilution of control makes a sense. At a current valuation, Reliance may not be interested in diluting the huge stake. They have diluted hardly 10-15%, 10 to 12% maximum in Reliance Jio. So these geo platforms, I told you now, I like a platform-based company. What Netflix has done to the United States, Jio can do to the heartlands in India. Jio is really not looking at the luxury customers. Jio is looking at the person who is driving that auto rickshaw, the person who is unemployed, person who has all the data with him but no work to do. Look at, so Jio is really looking at those persons and try to provide the data. So in my opinion, Jio will thrive off the debt and make a telecom a bigger play by combining with the uh, Kirana concept or the e-shopping that they want to launch. They want to become the next Amazon. So Reliance will go off big into this grocery shopping thing that India provides opportunity. Amazon is looking at 130 crore Indians, but Reliance will obviously look at it. So Reliance, in my opinion, is a must-have in a portfolio for any person. You should not try to bet against Reliance. Betting against Reliance is betting against India.
Okay, sir. Okay. So I think
Thank
we should
you.
stop. It is already one.
Yes,
One last question from my side. Is it the
yes,
right time
Chaitanya.
to invest right now? That is tomorrow,
In my
or shall I?
opinion,
Should we
in my
wait?
opinion, 25-30% of your money you can invest. In my opinion, in a short term, in the next let's say a few days or weeks, we are headed for a downfall. But if you have a fear of missing out, you have a FOMO kind of that is called a FOMO, fear of missing out, then you can make an investment of 20-25%. But I have made about 10% of what incremental I wanted to invest. Remaining I'm holding on because see, if I look at any financial crisis or any crisis in the last 100 years in the United States, such major crisis whenever it comes, market has fallen at least twice. So far, we have seen only one fall. In the month of March, we had a brutal fall in the United States as well as in India. Thereafter, we have risen up very fast. That is, we are almost retraced. This is called a retracement in the stock market. We are already retraced to 30-40%. So we are headed to a good fall. That fall could have been avoided had the economic package announced by the Modi government would have been very, very good. In terms of amount, the package is good. In terms of branding or the presentation, package is good. But the package is failing on one part, that is creating a demand. The good part that they have done is a deregulation of certain industries yesterday. Today, I have not seen. Today, the timing when we started and the Nirmala Sitharaman's press conference, both were same. But they have done a good deregulation. But the point that is not addressed by the government measures so far is a demand. Demand. See, the people who have lost the jobs, people who have lost daily income, how will they go and buy the basic necessities that needs to be ensured? Center for Monitoring Economy, CMI, it's a private sector body. They released a report on the 5th of May 2020 where they have predicted the unemployment rate in India is close to 27 to 30%. Now, if you have such a high unemployment rate, you need to make the consumer spending come back again, and for that money should be put in the hands of consumers, and that is where I have seen the measures lacking. You have provided more liquidity, more loans, but as a businessman, if I get a more loan, it's a measure on the supply side. I need to find a demand from a customer's end. So I think that measures have not been extremely great. Plus, in the United States also, the chairman of Fed, that is central bank in the United States, Fed, German Powell, made a comment day before yesterday, which he's saying that the recession is likely to stay a little longer than what is expected. For Fed has to come forward and make more, provide more stimulus. Yesterday, Democrats in the United States have announced a package or approved a package of $3 trillion. Trump had approved a package of $2 trillion. Democrats have approved it to $3 trillion. I don't think Republicans will approve it. But these short-term factors are basically indicating that the pain that a coronavirus has caused to the economy is going to have one more downside effect. So Chaitanya, you can wait for, let's say, some more time. Let's say, in my opinion, 8,700, 8,500 on a Nifty should be another good point. And if Nifty retests back to the 7,500, in my opinion, the probability of that is much lesser. 8,500, yes, there is a decent possibility. But testing back to the March lows is much lower, because India, whenever it has gone through a crisis, financial crisis, it has bounced back. If you look at the Indira Gandhi government, or let's say Narasimha Rao government, or Atal Bihari Vajpayee government, or Yashwant Sinha when he was a finance minister. Every time India has gone through the crisis, India has bounced back. So it's no different time, and we have a let's say a very strong leader as of now. Politically, we are at a very better position as compared to what it was in the past. So maybe government is lacking in terms of idea, but government is responsive at least. I call it as Nirmala Sitaraman put. So every see, she made a blunder in the last year's budget. So then she came forward and announced a corporate tax rate cut because she understood it. So government is understanding the problems. It is responsive. RBI is also responsive. So these measures will keep the market afloat. They will not go down to the levels of 6,000, 5,000. That is rubbish. So you can make a 10, 15% investment right now. Wait for some more time. 8,500, 8,300. If you see, make a good investment and just relax. Buy right and sit tight.
Thank you so much, sir. Thank you so much. It was really a very informative session. Thank you so much from the entire Pune camp CP study circle for giving such a wonderful session, sir. Giving your time, we are really
Yes.
thankful. And almost there were more than 800 live viewers today, sir.
Okay.
So,
Thank you.
and sir, special thing that now everyone is tired of the webinar, but still there were so many viewers, and it was really wonderful. So, thank you once again, sir.
Thank you, Chaitanya. Thank you for inviting.
Yes.
Thank you. Bye bye.
So to all the viewers, please stay updated. You can subscribe to the Pune Camp CP Study Circle YouTube channel, and you can know about our upcoming events. Thank you so much.
Bye bye.